I'd like to thank everybody for joining me today. Today, I want to talk about buy-sell agreements and how buy-sell agreements work as the bridge between our business planning clients and our estate planning clients, and how these tie together to make a cohesive plan for our clients that own closely held businesses. If you start looking at, really what the core point is here, think about the business protection. A buy sell agreement controls that transfer by agreement. So at the time a transfer happens, one of the triggers is comes and it becomes relevant, that there's not panic, that this allows us to provide an opportunity to show a cohesive plan to our employees, our lenders, our vendors, our customers. They see a very stable business environment, and it preserves the control over that business. From the estate side, a lot of times we're turning an illiquid business asset into cash that can be moved through the estate plan. But the big part of this, it reduces that fight over, control and value and timing, and make sure that we have a very coordinated plan that fits right into the estate plan, especially when we have so much value built into one asset that needs to be transferred upon those triggers happening. From an advisor's point of view, we want to make sure that we're reviewing the agreements, making sure that all of the valuations, the funding, that everything is in place. So when the buy sell is needed, when a trigger and event happens, it's easy just to move, from point A to point B, and it's just filling in the numbers to make sure everything works right. Now, this is not just a product sell. This is making sure that we have a coordinated plan that works for our client. Now, if you think about it, what does the business need? The business is looking for continuity, control. They're looking for that operating authority to make sure everything happens so that there's confidence in our business planning. From the estate side, the estate is looking at this and they need liquidity. They need to make sure that the business is sold and transitioned in a timely fashion. But more importantly, we want certainty and fairness among the heirs. Certainty in the plan that it's going to work, and that as we're dividing and distributing the asset according to the estate plan, that we can do it in a manner that makes sense. Makes sense for the owners of the business, mom and dad in most cases, and so that everything flows the way we want. The tie to this is making sure the buy sell agreement works, that it's all the details are ironed out. We have funding in place and everything moves through in a meaningful manner. If you look at, here's 5 things that, will upset and create a problem with our buy sell agreement. If we don't have a buyer, think about this. The estate has this business asset. Well, if they haven't, prepared for somebody to buy this, we may be losing value or losing control because we haven't planned that in advance. The does the survivor have the liquidity to buy out the business? So if we have 2 owners, the senior owner dies, the junior owner doesn't have liquidity or the cash flow to be able to pay for that business, now we have a problem. I see a lot of times that there's just bad valuations, that they put a fixed price on the business that no longer makes sense, but it's a contract. We may be stuck with that lower bad valuation, or we have a formula in place that no longer makes sense. So we want to make sure as we're planning that the valuation, no matter how it's designed, is designed properly and it's updated on a regular basis. The other part that we can see is, we just have the wrong structure for the buy sell agreement. We can have cross purchase, redemption, or hybrid, and each of those designs differ materially in how they operate and what the result is to the owners of the company. And then finally, there's no estate integration. They only pictured or only thought about the business side of this transaction, didn't take into account how this affects the estate planning side of the transaction. So if we have the wrong buy-sell agreement designed wrong in comparison to our estate plan, we're going to get a result that nobody wants. So when you think about the agreement, structure matters. So first of all, we can have a cross-purchase agreement. A cross-purchase agreement is the agreement is between the buyers of the owners of the company. The company itself is not involved in this contract. It is just the owners, and if owner one dies, owner two buys them out, and vice versa. So it really creates an easy to operate plan and easy to implement plan. But if there's more than two owners, that can be cumbersome, especially when we bring in life insurance to fund the buy sell agreement. We can move to an entity redemption plan. What in this case, the company is part of the agreement. In the event that there is a triggering event, the company buys out that owner, that shareholder. And so there again, this can work. It might create some basis issues for our continuing owners or our survivor, but it's something that can be simple to administer. Finally, we can have a hybrid. This you'll hear it as a hybrid or a wait and see. This allows the surviving partner to decide how they want this to operate. They'll typically have an option to treat it as a cross purchase agreement, an option to treat it as a redemption agreement. But finally, if they don't elect one of those options, it's going to have a mandatory redemption so that the deceased shareholder or the leaving shareholder knows that they're going to get bought out. It's just one that the surviving partner gets to decide how they want to do that, from a tax perspective, from a cash flow perspective, and liquidity. So I like all three. It just depends on the circumstances we're trying to create. If you look at funding becomes a big part of the buy sell agreement. When we're doing the transition planning, we want to create an opportunity to where we have leveraged dollars if we can, and that's a lot of times we'll have life insurance for that. But think about this: if I'm the one that's being bought out or my estate is being bought out of that business, I want to know there's money there to buy it out. So an unfunded promise becomes a problem. If we don't have that money, if we haven't created that sinking fund, the life insurance funding, whatever it is, to make sure that surviving owner can actually write those checks that need to be written. And so it's good to dedicate some of the liquidity of the company to the future buyout, whether that's a sinking fund, buying life insurance, whatever it is, that we know that there's money there when a triggering event happens. The nice thing about life insurance, think about life insurance as leverage. We pay that premium for a bigger death benefit, or we pay that premium to create that sinking fund inside the cash surrender value. But if we do this, if we have life insurance, we want to make sure the ownership and beneficiaries are correct, to make sure that when there's a triggering event, that policy is not a problem, but that policy actually fits in with the buy sell agreement. And then we want to make sure that everything is designed properly with that policy, and that it's identified with the agreement. So there's absolutely no questions that policy is part of the plan, and it's been designed to fit in with the buy sell or transition planning. And then we want to review it on a regular basis to make sure that stays up to date, and that we have a good life insurance asset there at the appropriate time. If you think about the estate planning, from the estate planning side, we want to know, who's going to receive the cash from the buyout, who's going to control the shares of the company, and there again, who needs protection. All of these parts of the estate plan can be integrated into the buy sell planning as well, so that when the triggering event happens on the business, we already know what the steps are going to be from the business side and from the estate planning side. So if you look at this, we want to make sure we have a current signed buy sell agreement. We know who the owners are, what they own, how much they own, and what the tax status of the entity is. We want to make sure we have the right triggering events in the buy-sell agreement, a good valuation method, whether it's formula, fixed price, or something that is easily updated. We've got a funding source for the buy-sell agreement. And if we have life insurance, the policies are correct. And then from the estate plan side, we make sure everything fits in the current estate plan. So the goal here with our clients is identify our business owners, collect the current agreements, and then ask them the questions that will lead us to helping make sure that that plan is up to date and kept current. So I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.